Welcome traders to another educational video titled 3 White Soldiers. 3 white soldiers are identified at the end of a decline, at the end of a downtrend, and it indicates this pattern, aggressive bulls, aggressive buyers if you wish, entering the market. Now, let's go and look in more detail at the specs of this reversal pattern. Of course, it consists of 3 Japanese candlesticks, of 3 long white candlesticks, long white real bodies, one after the other, where each open price is near the close price of the previous candlestick, where each open is near the closing price of the real body. Very good. And of course, the implication of this reversal pattern when identified at the end of a decline is bullish. Let's identify the 3 white soldiers pattern at a real chart, and I'm sure you can see it clearly here. It's at the end of the decline. And I want to mention here that this holds for all reversal patterns, for all Japanese candlestick reversal patterns. The reversal might not be immediate. So after we identify a reversal pattern, it's not guaranteed that the next candlestick will move higher than the pattern. It might take few candlesticks before that happens. And we should always keep in mind, and with this in mind, we can alter our entry in the market. For example, by looking at this chart here, you see that the 4th candle, the black candlestick, declines before the market moves higher. And perhaps for some traders, this is a good entry point. So after we identify the pattern, the reversal pattern, some traders will hope for a consolidation period, a short consolidation for some candlesticks to decline in the reversal pattern so they can enter the market at a lower price. So that implies that the risk will be even lower. Right, let's move on. Let's take a look at a very simple strategy using the 3 white soldiers reversal pattern. Now, and once again, we can see a support area near the lower band of the Bollinger Bands. Yes, 3 white soldiers. And of course, we enter the market with a buy order right above the pattern, right above the high price of the pattern. This is what we always have been doing, with some exceptions, of course. And if you wish to wait for a decline in the pattern before you enter the market, then it's strictly up to you. Good. Some traders will do that, by the way. And then we place a protective stop loss right below the low price of the pattern. Again, as you can see here, there is higher risk, but then again, we might expect a higher reward. Who knows? But nevertheless, what I'm trying to say is that some traders might choose to place the protective stop loss right below the low price of the 2nd candlestick instead of the low price of the pattern. Again, this is up to you. And take profit in this case is when the market touches the upper Bollinger Band. And anytime we identify a reversal pattern in the opposite direction, it's a good excuse to exit the market. Good. Let's go to another strategy. In this strategy, we use oscillators. And the preferred oscillator in this strategy is the relative strength index, using the default parameter of 14 periods. And when we identify any reversal pattern, we want additional excuses before we enter the market. And the oscillator being oversold, meaning below the 30 level, it's another parameter that we might use in our strategies. So in our case, the RSI, the relative strength index, is below 30, meaning it's oversold. Then we identify on the chart the 3 white soldiers reversal pattern. We feel confident now, and of course, we're going to place a buy order right above the high price of the pattern, and at the same time, a protective stop loss right below the low price of the pattern. Take profit strategy, straightforward. At the 200% level, we're going to close part of our trade, and another part we're going to close at the 300% level. Anytime we encounter any reversal pattern in the opposite direction, it's a very good excuse to exit the market altogether. Excellent. Another strategy here, we identify the white soldiers at the end of the decline. We place a buy order right above the high price of the pattern, a protective stop loss right below the low price of the pattern. You never know what is going to happen next, right? So we need to protect our capital at all times and take profit strategy. Now we're going to use the 161.8% Fibonacci ratio to book some profits so we can reduce at the same time our exposure. So by closing part of our trade, it has two benefits. We take some of the profits and we book them, and at the same time we reduce our trade. Good. And of course, after taking the first potential profits, we're going to look for a close below the moving average. Yes, if we encounter any close below the moving average, in this case it's a 20 period linearly weighted moving average, then we're going to close the remaining of our trade. And in this case, there is a long black body in that it's a good excuse to exit the market since it's closing below the 20 period linear weighted moving average. The method of the moving average and the periodicity is up to you to choose your favorite periodicity and your favorite moving average method. Of course, we can introduce once again in our strategy any reversal in the opposite direction. It's a good excuse to exit the market. I hope you enjoyed it, guys. Before I let you go, let me show you a very last strategy so you can have a comprehensive idea with a lot of parameters, a lot of variations, so you can come up with your own strategies. In this case, we're going to use the moving average convergence divergence indicator. It's located right below the price chart, and we're going to look for MACD, moving average convergence divergence, being positive. Yes? So before we buy, we look for MACD being positive, and this is true in this case. Then we identify the three white soldiers. We play a buy order right above the high price of the pattern and a protective stop loss right below the pattern like we usually do. Potential profits at the 200% level, part of our trade, we're going to close at the 200% level, and then we're going to close another part of our trade at the 300% level, and the remaining at the 400% level. But in any time we encounter a black body closing below the moving average or any reversal in the opposite direction, then it's a good excuse to exit the market by closing the remaining or whole of our trade. I hope you enjoyed it, guys. Don't forget to subscribe below, like, comment, and I see you in another exciting educational video.